Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to a brand new week of Money Talk. It's Monday the 12th of June. I'm Peter Lewis and thank you for making this podcast one of the most listened to finance and investment podcasts in Hong Kong. Last week on Apple Podcasts, we reached number 7 in the rankings of the most listened to finance shows. You can also listen to us on Google Podcasts and Spotify. Just search for Peter Lewis's Money Talk in your favourite podcast app. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, former US President Donald Trump has been indicted by a federal grand jury over the mishandling of classified documents, making him the first former president to face charges brought by the federal government. Consumer price inflation remained close to zero in China and factory gate deflation deepened, plunging by the most in 7 years. China's annual consumer price inflation rate edged up 0.2% in May from April's 26-month low of 0.1%. China's factory gate deflation deepened. Producer prices, which measure the price of raw materials and goods leaving factories, fell 4.6% compared with a 3.6% drop in April. It was the 8th straight month of producer deflation and the steepest fall since February 2016. The US and 5 of its major allies condemned economic coercion and non-market policies regarding trade and investment in a joint declaration Friday that didn't single out other countries but appeared to be aimed at China. Australia, Britain, Canada, Japan and New Zealand jointly released the statement with the United States, emphasising that trade-related economic coercion and non-market-orientated policies and practices threaten the multilateral trading system and harms relations between countries. Reuters is reporting that US Secretary of State Antony Blinken will travel to China this week for long-delayed talks aimed at stabilising tense relations, and a US official said is expected to be there on June the 18th. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Carlos Casanova, Senior Asia Economist at UBP. Providing a view from mainland China will be Shanghai-based independent economist Andy Scher. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Friday, US stocks reached a 10-month high as investors looked ahead to inflation data tomorrow and the Federal Reserve's latest policy announcement this week. The S&P 500 ended the day up 0.1% at 4,299, touching the 4,300 level intraday for the first time since August 2022. The gain pushed the blue chip stock index deeper into bull market territory as it rose 20.2% above its most recent low in October. However, trading was muted as investors showed caution ahead of this week's Fed meeting. Trading in the S&P was the lowest daily trading volume since October 2022. The Dow traded up 43 points or 0.1%, closing at 33,877. It was the Dow's 4th consecutive positive day, and the Nasdaq Composite rose 0.2% to end at 13,259. On a weekly basis, the S&P 500 rose 0.4% to record its 4th consecutive weekly winning streak. The Dow gained 0.3% over the 5 sessions. The Nasdaq Composite was up 0.1% over the same period for its 7th consecutive week of gains. The CBOE Volatility Index, or VIX, hits 13.5, its lowest level since the onset of the coronavirus pandemic 3 years ago. The Fed is expected to hold off on raising interest rates on Thursday morning, marking the first pause in its 14-month endeavour to tame inflation. Traders are pricing 70% odds of no change in June, but in July there's a 70% chance of at least another 25 basis point increase. The yield on the 2-year Treasury note, which is sensitive to rate expectations, rose 8 basis points to 4.6%. The US dollar fell for the second week in a row, losing 0.5%, while Brent crude oil settled at the low of the session Friday, down 1.5% at $74.79 a barrel. In Hong Kong, the Hang Seng Index rose 91 points, or 0.5%, to near a 2-week high of 19,390. The index chalked up a 2.3% gain for the week, the most since May the 4th. And this morning, the Hang Seng is projected to open 90 points lower. That's about 0.5%. On the mainland, the Shanghai Composite Index climbed 0.6% to 3,231, almost recouping all of its losses from the previous week. Last week, the Shenzhen component touched a 7-month low, and Shenzhen's tech-heavy Chinex hit a 3-year low. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us, as always, on a Monday morning, Alex Wong, Director of Alex K.Y. Wong Asset Management. Morning, Alex.
Good morning, Peter.
And also joining us, Carlos Casanova, who's Senior Asia Economist at UBP. Morning, Carlos.
Very good morning.
Consumer price inflation remained close to zero in China in May, in a further sign of sluggish demand across the mainland economy, and factory gate deflation deepened, plunging by the most in 7 years. China's annual consumer price inflation rate edged up 0.2% in May from April's 26-month low of 0.1%, but that was below market estimates of 0.3%. On a monthly basis, consumer prices dropped by 0.2%, the fourth straight month of declines, compared with estimates of a fall of 0.1%. And China's factory gate deflation deepened. Producer prices fell 4.6%, compared with a 3.6% drop in April, and compared with economists' forecasts of a 4.3% fall. And that was the 8th straight month of producer deflation and the steepest fall in more than 7 years. So, Alex and Carlos, not much sign of inflation there, is there? In fact, zero consumer price inflation and deflation on the producer price front. What should we take of this?
I think it means the China economy actually is worse than expected. So we are seeing weak demand from consumers, and also probably during the COVID period, manufacturers have relocated some of their manufacturing facilities outside China. So that is also affecting the manufacturing activities in China as well. And also, of course, the commodity prices actually have come down a little bit, and also that have helped to depress the PPI.
Yeah, I agree. We are seeing sort of that trend across the world, right? It's not only in China. We are seeing weaker food and energy prices weighing on the headline figures. Of course, in China, these are much lower than in other parts of the world. But core inflation sort of remaining higher than headline CPI in many economies around the world, and China is no exception. The demand has been quite weak. There's been a rebound in demand for consumption of services, of course, post-reopening, but demand for things like housing, cars, white goods, and goods that are not related to consumption of services. So, of course, makeup is up a lot because people are going out more to restaurants and bars. But nobody is really buying computers, cameras, and motorcycles. So that remains very weak, and we are seeing sort of that translate into very sluggish inflation. We do think that on the consumer front, we might have reached a bottom. So we are going to likely see a very slow and gradual increase in inflation in the months ahead. I think the consensus is 1.2 for this year, so it's not a crazy rebound by no means. But what worries me more, and what also has more serious implications for the global economy, is the producer price inflation actually declining so much. So firstly, it means that there is significant weakness in the manufacturing sector, and that is never good from an economic recovery standpoint, because you have sluggish investment by corporates as they reduce their capex to try to lower their headline costs, and also slower job creation, which is something that they are going to have to think about over the summer months. So it looks like it complicates the picture for the economic recovery, and of course, for the rest of the world, it means that China is already exporting deflation. Never mind what happens on the consumer front. What matters is PPI in terms of US CPI, which is also this week. So I think China is already exporting deflation, and that's something investors are looking at as well.
Why is it? I mean, Yi Gang was saying that a large part of this is because of falling commodity prices. Why is PPI so weak in China compared to the rest of the world, given the rest of the world is also affected by the same commodity prices? But here we have deflation, don't we? Quite rampant deflation. Why the big difference?
In my opinion, there's two factors that are driving this decline in PPI. First of all, we are seeing a slowdown in external demand. So we are seeing exports to key markets in the US and also ASEAN last month was negative double digits. So we are seeing falling external demand. Naturally, the manufacturing sector contracts as a result, and you have excess capacity in some areas. So we are going to see a contraction. The other factor is, of course, the domestic investment side is also weak. So typically a lot of these manufactured goods, things like metal, steel products would go into the construction of housing and infrastructure, and that is not happening at a very high rate. So you are seeing a contraction in manufacturing.
So if we combine all the data together that we've seen over the recent week or so, this inflation data, the trade data that we had last week, seems to suggest the economy is cooling quite rapidly, doesn't it? Much faster than people thought.
Yeah, so I think that's why the market is expecting some policy support from the government right now already. So we probably may see some more aggressive cuts in rates in China to try to boost the economy.
Yeah, I agree with Alex.
Why not so far, though? They've been quite reluctant to do it, haven't they? They haven't cut the RRR yet, and they certainly haven't cut interest rates. They seem to prefer credit tools to try and sort of boost the economy rather than targeting interest rates. Why are they so reluctant?
Can I be a little bit controversial?
Of course. Please.
So we had actually more pressure on the economy last year, and Li Gang held from implementing more stimulus in spite of calls by the then Premier Li Keqiang to do easing. So with Li Qiang now as the Premier, I think there is less sort of discordance in terms of the discourse, and so it is less likely that they are going to do broad-based rate cuts as a result of this. I think PBOC has to juggle three different priorities: stabilizing inflation, stabilizing growth, but also reducing risks in the financial sector, and those objectives conflict with each other. So I don't know how Li Gang is sleeping at night. He has a very difficult job right now. And so in that sort of environment, it's natural for him to always lean on the side, err on the side of being more cautious and doing more targeted support. The sequential slowdown in Q2 is quite obvious. I don't even think they have to wait until Q2 data is out. They will see it this week with activity indicators for May. And that should be enough for them to be slightly more aggressive. So RRR cuts would probably be his preferred option. He did mention in March that he would consider another RRR cut. But because there's this overhang of reducing risks in the financial sector, all of the concerns around local government debt, I think they're going to be quite restrained from a top-down perspective in terms of delivering that final rate cut, which is what all of us investors are sort of hoping and waiting to see.
Yeah, but it's been a long time coming because they haven't changed interest rates for quite a long time. Would it make much of a difference anyway? Is that really the solution to China's economic woes at the moment?
I think in the meantime, they are trying to cut the deposit rates more aggressively and try to induce investment from local citizens. So I think that's the strategy right now because the Chinese actually are sitting on a lot of deposits. So that's why they want to channel those deposits into investment or into equities or even REITs, I think. So this is probably the safer rates to try to cope with this current situation.
Carlos, you mentioned that the risk is that this deflation gets exported around the world, and you indicated sort of that there are signs that is happening already now. You think that is that's going to be the case, and this is going to reduce the inflationary pressure in the US and the Eurozone and elsewhere?
100%. I think you are seeing already downside pressures. I mean, we're coming from a very high base, so it's not directly comparable, but we are seeing downside pressures on headline CPI numbers in the US and Europe. And that reflects both the fact that China is exporting deflation, but also there's been a rotation in terms of demand away from goods and towards services. So the only thing that is really driving sticky inflation in developed markets is wages and positive spillovers that these have on services. But of course, in markets like the US, if there's a down cycle in terms of economic activity, employment and wages tend to move very quickly. So I think it's a tail risk that we need to monitor whether or not this is going to translate into a perhaps faster than expected correction in inflation. But by all means, the baseline sort of scenario for most banks is that you are going to still see this resilience in the labor market pushing services, but on the goods front, definitely helping with downside pressures from China.
What do you make of the 6 state banks last week cutting their deposit rates by what was about 10 to 15 basis points, wasn't it? Two-year deposit rates fell 10 basis points, 3 and 5 year time deposits by 15 basis points. Is that going to have any major impact?
Well, as Alex mentioned, they are being much more targeted, and they're trying to hit the balance sheet of households. We've all seen the statistics about the pandemic surpluses that have built within households. Mm-hmm. And unfortunately, in the current environment, households are very hesitant to deploy those savings because there is uncertainty, and there are also no good alternatives. Traditionally, Chinese households are very exposed to real estate. The expectation is that's going to be very sluggish. Chinese equities are not really taking off. A lot of concerns in the bond market still with the developers, and so there's nowhere to really to plonk that money, really. So they are going to have to be very, very strategic, very targeted, very bottom up, and try to find ways to deploy those buffers in a meaningful way that actually triggers economic activity. So I think in the very short term, the impact of the deposit rate cut is going to be quite muted. It might take a few months, but remember, they're not doing this in isolation. They're also simultaneously reducing some of the macroprudential rules for home ownership in second and third tier cities. They're also boosting demand for EVs, boosting demand for household goods. So they're going about it in a much more pragmatic, bottom-up manner, and it's going to be difficult for us to track sort of the scale of the stimulus package because it's going to be so scattered.
Well, let's see what the impact is on the markets. Let's stick with China. First of all, obviously it's going to be an important week, isn't it, for markets with the Fed meeting. We've also got US inflation data today. There was an interesting comment from the stock market regulator on Friday. They want to encourage a new bull market in stocks by encouraging investors to turn to long-term value investing. Yi Human, who's chairman of the China Securities Regulation Commission, said that at the Luzhu Forum in Shanghai. And he wants to encourage funds to increase their equity allocations. I Alex, took this as him basically saying, invest in state-owned companies.
Right.
Is that what he means?
I think if you talk about value, then in China, probably you are talking about SOEs. So because those private enterprises actually are not too cheap in China, in the Asian market. But in Hong Kong, they are quite cheap. But people, I think, would not like to invest in tech companies in China because they lack the big AI firms, I think, because AI probably in China would be limited by the chips technologies and also the potential risk of government regulating. So I think they are talking about the SOEs, and we are seeing continuous strength in the telecom sectors and also the petrol sector. But probably we would see renewed strength in the banking sectors in the equity markets because we are seeing cuts in deposit rates already. So if those residents are not moving their deposit into equities, at least the banks will benefit from improving margins. And also for many Hong Kong companies, actually they are more keen to borrow renminbi now because this is much lower than Hong Kong dollar lending rate and also US dollar. So we are probably seeing some quality borrower coming out from outside as well because the renminbi actually is cheaper to borrow right now, and also the exchange risk actually is not that high. So I think the overall scenario would be better for those banks, and probably it will lead to the index to stabilize because at least the banks are quite an important part in the Asia index and also in the Hong Kong market as well.
If you go back to the beginning of the year, the bet on China has probably been the biggest mistake that sort of analysts have made, haven't they, in the markets? So many people were calling for a bullish run in China, which really just hasn't worked out at all. But are you getting signs that maybe now is the time? It was just the wrong time at the beginning of the year.
I think you still need to focus on SOEs because I don't think the private enterprises would benefit much. As I've said, right now the global theme is AI, and people probably would be more comfortable in investing in other Asian semiconductors companies because of the ties with the US. And then for platform companies, I think people would not be very confident that the Chinese one would be able to compete with the global ones eventually, because they probably will be limited by chips and also be limited by the government regulations. So the ultimate upside in Chinese tech actually will not be that high. So that's why I think Chinese private enterprises probably will underperform. But for SOEs, they are not expensive at all because they have been underperforming the overall global markets for maybe 10 to 15 years already, and they are offering good dividends. Of course, they are quite short-sighted because the KPI for them are dividend ROEs, so probably they would not have too much interest in investing aggressively to catch up with the tax, because in the US people don't care about short-term earnings that much. If you look at NVIDIA, people care about the ultimate dominance in their respective industries only, so they are not caring about the high valuations right now. But in China, SOEs actually are more concerned about the short-term performance, so probably that would limit the upside eventually as well. But I think people will feel more comfortable in investing in SOEs. Actually, this year, if you put your money in Chinese telecoms companies, you probably at least you got 30% plus return on those three companies. So that is not bad actually as compared to other markets.
Carlos, what all the economic data that we've had, what does this mean for the yuan? Because that's been weakening as well, hasn't it? And we're down maybe about 3% now, I think, on the Chinese yuan this year. But what does it do for the outlook for the currency?
Well, in the near term, we are expecting yuan depreciation. We have a strong dollar still. We have a widening policy differential with the US. And we have concerns about a growth slowdown in the second quarter. So we are expecting that number to potentially head higher towards 7.2, which is weaker than what we had expected at the beginning of the year. There's also been some changes around the US dollar view, I think, globally, and so that's playing a big role. In the second half, depending on when we expect to see a deceleration materialize in the US, we could see some marginal appreciation of the yuan towards 6.9 in that range. But of course, against the basket of currencies, the yuan will not appreciate meaningfully this year because they intervened so heavily in the market last year. It's going to be much easier for other Asian currencies to outperform. So we are looking at a sort of slight depreciation and then range bound for the second half of the year.
And what about Chinese bonds? Foreign investors have pulled out quite a lot of money now from Chinese bonds, 7.2 billion worth in May, and that was after $10 billion withdrawn from them in the previous month in April. Yields on the 3-year bond, they're down about 38 basis points from near the end of January. What's the outlook for Chinese bonds?
I think still weak demand because of the foreign investors have been hurt over the last 2 years in investing in Chinese bonds. I think that kind of psychology would still remain in the market. And also people probably would not feel good about the recovery prospects of the Chinese property markets as well, because Chinese actually the birth rate is low and marriage rate is low, so the long-term demand actually is not that high, and people are talking about the successions of several Feds from the seniors for Chinese residents right now already. So the long-term outlook actually is not that good for that sector. And then for manufacturing companies as well, I think people would not feel too good about lending money to them. So probably we need to see a new sectors in China to come out to lend money. Otherwise, I think the bond market for Chinese actually would be quite bad.
Now, obviously, it's an important week in the US. We've got the Fed meeting. We'll get their decision in the early hours of Thursday morning, Hong Kong time. Before that, we have got inflation data coming out tomorrow. Carlos and Alex, I'm sort of a little bit surprised in some ways that the Fed has rolled out all of these officials talking about a pause in rates this month, which they were doing before they saw the jobs data last week, which didn't really help their case. And also, of course, depending upon what the inflation data says tomorrow, they may end up in the situation where they've got to change tack, haven't they, and maybe think about raising rates further because inflation isn't getting anywhere close to their target.
Inflation is, I think they have better visibility than they did a few months ago with regards to the trajectory for inflation in the coming months. And I think that's perhaps emboldened the Fed to come out and, be a bit more dovish, propose this hawkish pause in June with the outlook to potentially do another 25 basis point rate hike in July. Certainly that's what the market is pricing at this point in time, but you are indeed correct. If there's a significant surprise with CPI numbers this week, I think they will have to shift gears, as they've also left the door open for another 25 basis point rate hike. So they could do it earlier. They could do it in June instead of in July. But given what we are seeing with headline inflation across the board in DMs, with goods being slower, services still resilient, I think they might still have enough arguments there to hold this month.
Do you find it slightly odd that what they're really saying is that next month we're going to raise rates because we still haven't gone far enough in taming inflation, but we're sort of going all out to make it clear that this pause in June is not the end of the rate hiking cycle. It's just a skip, if you like. That's their words. But why would you do that if you know that you're behind the curve on inflation, so that you're going to have to do it next month? Why wait until next month? What will they find out next month that they don't know already? Why not just do it right now?
I think this is a bit odd, but anyway, I think the inflation actually probably would be peaking because we are seeing weakness in commodity markets already. So what is resilient is, like Carlos said, is the labor market. So I think they do have some room to wait, and probably since they are so data dependent, so in July probably they would change some stance on some weaker unemployment data. So who knows? So I think that's why they are doing this.
We could see a more divided Fed than we've seen before, though, couldn't we? Normally they've been pretty unanimous on what they want to do, but there's definitely some hawks there on the voting FOMC.
Yeah, the communication is going to be confusing even if they pause. We are going to see a very mixed tone coming out of the Fed, and that's going to throw the market off, which is possibly what they want. I think forward guidance isn't really serving them well right now. So throwing investors off a little bit is possibly a good thing for the market.
So what does this mean for US stocks then, Alex? They're at a 10-month high now, the S&P 500, but there are signs now, aren't there, of this outperformance of tech stocks over value stocks sort of reversing. We saw the Russell 2000, it notched a weekly gain of about 2% last week. It looks like there seems to be a rotation going on.
But that rotation actually is weak. I think people are still quite keen for the big AI firms. If you look at Adobe, actually they just laid out some plans on AI, then the shares just break out on the upside very strongly. So the AI firms actually are playing out. And I think people would still be very confident on several big stocks like Apple, Tesla, Nvidia, and Microsoft. I think these four actually would be the representatives of four firms: the AI infrastructure, the AI platform, the consumer electronics, and the EVs. So these four leading companies, I think, would be the supporter of the Nasdaq right now, and probably those companies, those software companies probably would also catch up on the AI firms. So I think tech probably will still be the leader. So we are seeing some spillover into values, but the values sectors actually would be more dependent on the rate outlook. So that is not like AI firm, because AI firm, the story is too big and people would not care about the interest rate outlook. So I think eventually the market will still be led by technologies right now.
And can they outperform any more? I mean, they're already, those four stocks are about 25% of the S&P 500. It seems like something somewhere else has got to catch up.
But I think that four firms actually would be the very big firm for the next 10 years. So we are talking about AI's infrastructures building, AI platform, consumer electronics. I think people underestimated Apple's Vision Pro. I think that probably would be the next growth driver for Apple in the next 10 years. And then techs probably would be more valued right now because people talk about their grid. So I think these four actually would still be strong. But if you look at Meta's, Amazon, and Google, I think probably they would not be doing too much. But anyway, I think people are now more bullish on the software companies already. So probably that would help another wave of upside in Nasdaq because of the renewed interest in the software companies in the AI futures. Although I think that probably will support the Nasdaq to in the next probably 6 months.
And what about the regional banking stocks? When we had this sort of crisis a few weeks ago, there was concerns that it was going to impact credit conditions and that would start to slow down the economy. 4 to 5 weeks later, is that still a concern? Are we seeing signs of that?
Yes, that is still a concern, but I think that concern would not be a big factor in the market. Probably they would have limited impact. So I think SMEs probably would be affected by that. But in the stock market, actually, the stock market is dominated by big companies, so that would not have too much impact on the overall market. So I think they will have a polarized impact. So people would not be too keen in investing in small companies because of that credit crunch created by the problem in regional banks. But for the financial sector, I think people would feel more comfortable in buying those companies which are big or which are depressed, but they probably will have the resilience to come through this crisis. So probably we are seeing some polarized performance in the financial sector as well.
Carlos, are you seeing signs in the economy at all of that happening, of there being a credit crunch?
Well, the structural factors that led to this credit crunch in the first place, meaning this big differential between money market rates and deposit rates in the U.S., remain. So likely, the regional banks are not off the hook. We are still expecting pressures. Fed liquidity injections have helped to smooth out any concerns in the short term, but of course that liquidity has to be removed at some point. So we are expecting to see credit conditions tighten in the U.S. I think Alex is right. In the short term, that's not going to impact the big companies, but it is going to impact households through the real estate sector at regional level, and so that will eventually trickle to the big stocks if you see a material decline in U.S. activity. So I think we are looking at a sort of couple of quarters impact, not immediately, but it is a factor that remains in play.
Well, thank you both very much. You heard there Carlos Casanova, who is Senior Asia Economist at UBP, Alex Wong, who is Director of Alex K.Y. Wong Asset Management.
Peter Lewis's Money Talk.
I'm joined now by Shanghai-based independent economist Andy Sher. Morning, Andy.
Good morning, Peter.
Let me get your thoughts, first of all, on this inflation data that we had out of the mainland on Friday. Consumer price inflation, it's pretty close to zero, isn't it? And producer prices are in deflation. What is this telling you about the state of the mainland economy?
Well, I think that the issue is China has experienced, always has overcapacity. So now commodity prices have come down a bit. So I think that we have this price adjustment. And obviously the property sector is deflating, and that has a knock-on effect. So I think that it's not necessarily deflation in the sense that money supply is contracting. M2 is still growing at 12%. So I'm not sure that is the case. It's really about some of the quirks in the real economy.
So is it a concern? Should we be worried when you see producer price deflation? Or as you're saying here, it's not because of money supply, it's because of other sort of, if you like, structural factors in the economy?
Yeah, there is a global demand issue, right? Exports are down in May. And China really expanded production capacity during the pandemic when businesses didn't have a lot to do, and they focused on upgrading to so-called 5G and AI-assisted manufacturing. And that really massively expanded their production capacity. So, and China really wants to supply to the whole world, but we have demand cooling down because people in the West are not getting helicopter money from their governments anymore, and they overordered electronics during the pandemic, and half of China's exports are electronics. So we do have some sort of a downturn here.
So what is it then that's going to prompt the Chinese economy into growing? If exports to the rest of the world are slowing because the global economy is slowing, if consumer demand on the mainland is weak, the property sector still hasn't recovered, where is the growth going to come from?
Well, I think China's focus is not on growth anymore. It's just you lived there. What's the harm, right? So the labor market is very tight, and college graduates cannot find good white-collar jobs, which that problem cannot be solved by growth. China's growth is driven by manufacturing and the construction that don't create a lot of white-collar jobs. So in the sense that what China should do is really restructuring, balancing the economy, don't invest so much, and shift the money to the household sector to create to boost consumption, which the government doesn't like to do. So so what we're going to see is Chinese exports would become cheaper, and then a lot of business elsewhere will go under. So China's exports will expand market share. So the global economy needs to go through this kind of adjustment, and then more demand for Chinese goods.
So does that mean then that people are going to be disappointed if they're expecting stimulus, if the focus is not going to be on growth, but it's going to be on restructuring? Then there isn't really the need for things like RRR cuts or interest rate cuts, is there?
No, they never worked before. Yeah, I think monetary policy used to kind of fuel property speculation. And there is, I believe, a political decision not to do that anymore. The property sector is basically done, and it's on its own. So I think the economy is going to be very slow. We do have a bounce in the service sector, probably 7 to 8%. And the manufacturing so far is still growing. It's slowly. It's still growing. So but you ended up the year with at the low end you have maybe 5%. At the top end you have 6% growth rate. So it's not good for after 3 years of a pandemic, and so it means weak. So next year there will be a bigger challenge. There's no low base effect anymore. So I think that the government is going to take it easy this year. Maybe next year they'll think of something.
Well, then equity analysts are going to be pretty disappointed, aren't they? Because they are almost unanimous in calling for more stimulus in the form of rate cuts, RRR cuts. And, most analysts have been pretty wrong on the Chinese markets. If you go back to the beginning of the year, they had pretty optimistic forecasts. And instead, we've seen the MSCI China down almost 20%. Sounds like they're going to be disappointed further.
Yeah, we had this massive rally in the last quarter of last year, and that was not based on fundamentals. And it was so what we're seeing is that handing back that increase. So but I think the issue with the Chinese stock market has never been economic growth. It's the overcapacity, excessive competition. So you look at the Chinese stock market over the last 20 years, it hasn't done much, but the economy is up 10 times. So the issue is really about the structure of the economy that does not favor return on capital.
So if it doesn't favour really shareholder rights, does it either, or shareholder returns? There isn't really a focus on that at all. The central government, I don't think, likes the idea at all of returning profits to shareholders or doing share buybacks or increasing dividends.
I think that obviously from the government's perspective, its goal is make the country rich and strong. And it's not about making shareholders rich. And that apparently is East Asian story. You look at what happened in Japan. The people invest in Japanese stock market over this spectacular increase from 1950s over the next half a century, and basically didn't make a lot of money. So and you look at Taiwan, you look at Korea. East Asian model, because that they have high savings rates. They have savings. They like to mobilize savings to boost up production capacity. That means that there's overcapacity, a lot of competition. Return on capital is not great.
So what do you make of the support measures that the government has recently announced, getting state banks to cut their rates on deposits? It's also coming up with support measures for the property markets. Do you think they're going to work? Are they going to be any better than that 15-point plan that they had back in November?
No, in terms of the deposit rate, Chinese households want to pay down their debts early. So you cut the deposit rates, they have more incentives to do that. They don't have a lot of incentives to go out to spend money because they did not make money during the 3 years of pandemic, and they need to reaccumulate. So this is something you cannot overcome. To stimulate consumption, you must boost their disposable income by cutting taxes, maybe cutting all these contributions to so-called social welfare funds. Okay, so these welfare funds account for half of the labor cost. You look at the big thing, not the little thing like a deposit rate. So I don't think it has big impact. In terms of the property sector, it's really oversupply. There's not much you can do. The oversupply is overwhelming. 10 billion square meters under construction, 7 in the residential sector. And the commercial and office sector is basically collapsing. And there's a lot of debt over there. So it's a pretty serious crisis. The household sector does not really, in Chinese households, don't dump their properties. They held on, wishing that the price would come back. So the market does not adjust rapidly. But there is a full-on crisis in the commercial sector.
So if you need to boost household savings, household income, would consumption vouchers work in the way that we've seen them in Hong Kong? How much?
The Chinese government doesn't like to give out cash. So we saw that the local governments gave out some consumption vouchers, really tiny, very tiny little. So it's really for publicity. So Chinese government wants money. You look at most local governments now, really short of money because they couldn't sell land like before. So most governments are in some kind of financial distress. The only way, if you want to improve the situation, the central government has to issue bonds to sell to the household sector at a high interest rate. High interest rate, then people, instead of paying down their debts, they will buy your bonds. Then you spend that money to maybe prop up some local governments that are basically going under.
Where does Hong Kong fit in? Where does the economy here fit in? Sort of caught between China, which is weakening, and the West, which is also seeing a slowdown in demand. So what does this mean for the Hong Kong economy?
The first is Hong Kong does not have an independent international economy, not like Taiwan or Singapore. Hong Kong, everything is about the mainland. So forget about talking about Hong Kong as an international financial center. This is just wrong. The other is the problem with Hong Kong is that Hong Kong basically was doing two things for many years. One was raising money for the Chinese companies, and also kind of getting money from China for kind of speculation, whatever. So these things boosted the financial sector, and also Chinese money coming to buy properties. So on the monetary side, if Hong Kong is booming or whatever, you're talking about these three things. Or the other is that the tourism sector, Chinese wanted to buy luxury goods, and mainland imposes a 25% tax on luxury goods. So Hong Kong is an arbitrage place, and Chinese went there to buy luxury goods. But this part is really going down because the Chinese, after 3 years of a pandemic, people really have changed their priority. They don't want to buy an LV bag, spend $10,000 to buy an LV bag and stay in a terrible hotel and eating instant noodle. That thing is over. So they're going to Thailand and Malaysia for a good time. You pay a little bit of money to have a very good hotel room. You have beach, you have nice people, nice food, nice weather. And if you come to Hong Kong today, before you come, they double or triple the hotel rates. And the hotel rooms are terrible. So and the people in China, in the mainland, are not used to it because the housing condition or hotels are much better than in Hong Kong. So this is the problem, that Hong Kong doesn't have much to offer other than shopping. When people don't want to do shopping like before, so then Hong Kong is basically is dead. So Hong Kong's economy is going nowhere. And now they want to reinvent itself. They want to pivot to technology. They want to create these tech research centers. I think that, to me, is laughable that Hong Kong will become a technology center.
And why do you say that? You think it's too late? Is it too late for it to maybe...
No, Hong Kong culture is very short term. It's all about a speculation. The reason why Hong Kong is the way it is because of that. Because everything is about a speculation. And everything is about sucking money in to boost the property price. So then the money percolates down into the Hong Kong economy, but into the Hong Kong household sector.
And of course, the other thing is Hong Kong's led by US monetary policy. It's tied to that through the peg. Now, you say that the Hong Kong currency pegged to the dollar is not sustainable. Why do you say that?
Yeah, the reason is because that Hong Kong does not have an independent international economy. It's just part of the mainland, and it makes a living by arbitraging its special status, i.e. low taxes. Okay, so having a separate currency is not sustainable, and of course, so far it's still hanging on because the Chinese RMB has this dirty float is kind of linked to the dollar. But the issue you're looking forward, the dollar is not a stable currency because the U.S. has this vast fiscal deficit. Even though the economy is not in a bad shape. And it's a structural issue. The U.S. fiscal deficit will be bigger and bigger. So 10% of GDP fiscal deficit is going to be a routine thing. You cannot expect this currency to be stable. So this is where that Hong Kong, this peg will become a negative for the Hong Kong's economy.
So are you saying that what Hong Kong should do is it should abandon the US dollar peg and peg the currency to the yuan? Or are you saying that what should happen is should have the Chinese yuan?
Hong Kong should not have its own dependent currency at all.
So you're not saying repeg
just
it?
adopt the RMB.
Yeah.
And RMB, once it leaves the border, is convertible. So you don't have convertibility issue.
But it's not convertible now, though, is it? It's not convertible now. That's the problem.
It's not convertible inside China. It's convertible in Hong Kong. There's this offshore RMB component. Any RMB that goes exits the border is convertible. There is this architecture of offshore RMB that banks can transmit can send to each other as a convertible currency. And the China Central Bank has this offshore RMB exchange rate, which can be a little bit different from onshore, but because of the foreign exchange reserves are still very vast, they can maintain the parity. So it's not 100% safe, but considering China's foreign exchange reserves, they have the ability to keep it. So you have the convertibility and you have the RMB stability. So going forward, you have the benefit from both sides, and also that a global demand for RMB asset is growing. So and RMB interest rate is lower. So now suddenly Hong Kong assets all become RMB assets. And when the central banks, like in the Middle East or in East Asia, when they want to increase RMB exposure, and then Hong Kong is a natural place to go to. So Hong Kong becomes effectively an international RMB center. And it can ride this trend and have a second life. So I think that this is really the second. This is really an opportunity for Hong Kong to reinvent itself. Pivoting to technology is just kind of burning some money and to have hope, right? To buy hope. So this is something real, and it fits into Hong Kong's strength. Hong Kong people like to speculate, like to move money around, and here's your chance that RMB becomes international, and you try to flog this to foreigners, to somebody from the Middle East or whatever. No, you can do this job and make yourself rich too.
So just to be clear then, what you're saying, you're not saying that the peg is going to be broken through some speculative attack, because there have been some funds who have been calling for that and they've been badly burned when they try it. What you're saying is that Hong Kong should voluntarily abandon that peg and adopt the Chinese yuan as its currency. That's
right. And in terms of attacking Hong Kong dollar, It's like when the Big Short in 1997 in November on his private jet, this biggest macro fund guy, and called me, said, do you think Hong Kong dollar should devalue? I said, yes. He said, do you think Hong Kong dollar will devalue? I said, no. So basically, and he didn't listen to me. He lost a lot of money, lost more money than anybody else in this attack on Hong Kong dollar. But the issue is that Hong Kong can let the interest rate rise. So it's and after this attack, Hong Kong has really tightened up its banking system. It's not so easy to borrow Hong Kong dollars anymore, right? So you look at Hong Kong dollars balance in the cash balance in the banking system is tiny. It's tiny. If a hedge fund really can borrow their money, the interest rate will go through the roof. And that's another vulnerability of the peg right now. Because the Hong Kong interest rate is lower than the US dollar interest rate, you either have to burn the foreign exchange reserves or you let the cash balance to go down. And right now, it's the latter. That means that it's really vulnerable to a spike in interest rate. And think about how vulnerable Hong Kong's property market is. And that's everything for Hong Kong people.
Well, Andy...
So the Hong Kong property market could collapse.
Well, it's fascinating to hear this. I'd love to talk longer about this with you, but we've already had quite a long discussion and we're running out of time, sadly. But it's great talking to you, Andy, and hearing your thoughts on this.
Yes, have a good day, Peter.
Thank you, Andy. That's Shanghai-based independent economist Andy Sher. Thank you for listening this morning. If you want more information on any of the stories we've discussed today, please take a look at my daily newsletter, which you'll find at peterlewismoneytalk.substack.com. Tomorrow on the show, I'll be joined by Asian fund management industry consultant Stuart Aldcroft, Pete Sweeney, financial columnist at Reuters, and from the USA, Tony Nash, founder of Complete Intelligence. See you tomorrow.
Money Talk